Hi friends, so I welcome you all for the discussion of the GST paper for the CA Intermediate November 2020 examinations. If I give the overall perspective of the paper, I find that apart barring a couple of questions, I think the rest of the paper was very much on the concepts. Yes, two questions definitely they were a bit tricky. I mean, as much as I find it for the CA Intermediate level, but then that is the beauty of our exams. So one or two questions they should be something where you just feel like ducking those balls away, but nonetheless the paper was overall good. I was only surprised to see one particular amendment that they had included in the paper, that was regarding the rule 36 sub rule 4 for the restriction of the input tax credit. Now considering the fact that yours was a November 2020 attempt, this provision initially came in November 2019. Thereafter, there was a lot of hustle bustle over the provision, and even I think with you all, with my friends who had been with them for the CA intermediate discussions, I had also said that this 36(4) amendment probably would not be very much bang on in your examination, but then that was one kind of a surprise, because in the industry as well there was a lot of hustle bustle on respect to this amendment on in rule 36(4), where the restriction of input tax credit was imposed on the basis of those invoices which are not appearing in your GSTR 2A. So nonetheless, that was one element of surprise which was also there in the as a part of your paper. Although the rest of the paper looks good, so what we'll do is that we'll discuss the non-MCQ part of the questions one by one. So here it goes. So the first one was K&K, a registered supplier of Mumbai, is a manufacturer of heavy machines. Its outward supply is exclusive of GST for the month of 2020 are as follows. So interstate was 85 lakhs, intrastate was 15 lakhs. Now precisely this question was about determination of tax liability. Okay, so determination of tax liability with respect to the outward supplies, with respect to the input tax credit, the provisions of input tax credit, and most importantly the restrictions of the restrictions of rule 36(4), which was there for the non-appearance of invoice in GSTR 2A. Now, like I said that yes, for the academics it really came as a surprise, because even this provision is not really settled in the practical circumstances, but then nonetheless that is how we will be answering the question now. So now, as far as the outward supply value is concerned, on the 85 lakh rupees we are going to charge the outward tax will be at 18%. On the 15 lakhs amount, that is on the intrastate supply, it will be 9% CGST, 9% SGST respectively. So now if I see the applicable rate is 9%, 9% and 18%, details of the GST paid on inward supplies. Raw material A, of which 70% inputs procured were used and 30% inputs in stock at the end of the January 2020. Now precisely under the GST regime, as long as the goods have been received by you, whether they are in stock or they have been used, that really does not matter in order to limit you from taking any kind of an input tax credit, unless there is something else which is going to stop you from claiming that credit. So as much as I see this, there is no problem, but we'll see the adjustments. Raw material, of which 90% material received in factory and remaining material completely damaged due to a road accident on the way to the factory. There was no negligence on the part of K&K Limited. Now there is a abnormal loss, although they have said that there is no negligence, but damage due to the accident or anything like that, there is no absolute any provision hitting on account of abnormal loss which is coming into picture. I mean, rather there is no normal loss, I can call this is definitely going to be called as an abnormal loss. Now most importantly, even before I go to section 17(5), I have a provision in section 16 section 16 of the CGST Act. Section 16 mein it has clearly been mentioned that input tax credit is eligible in respect of those goods or services which have been actually received. Now even before going for the 17(5) damaged goods, lost and destroyed, etc., I am really not really worried, because 17(5) will come into picture for disallowed credit. Right now we are not even received the goods. So out of the total goods, only 90% were received. Physically, how much goods have been received by you? 90%. So input tax credit will be limited to only 90% of this amount. That is, the tax amount is 50,000 of C and S respectively. We will have to limit it to 90%, that is 45,000 over here. For the first adjustment, I'll tell you, because there is some adjustment given at the end of it. construction of pipelines laid outside the factory premises. Now this becomes, I mean, this is not a part of plant and machinery, as it is an exclusion to plant and machinery, as it has been mentioned in 17.5. So the input tax credit is not eligible in this case. Insurance charges paid for the trucks used for transportation of goods. If you remember section 17.5 discussion again. So input tax credit in respect of motor vehicles which are used for transportation of goods is eligible. Thus, any input tax credit which is in respect of any insurance or repair maintenance services with respect to these goods, that will, I mean, these motor vehicles which are used for transportation of goods, that will also be eligible. So we are very much entitled for claiming the input tax credit in this case. So this will be eligible to us, eligible credit. There is no opening, now additional information is there is no opening balance of input tax credit and all necessary conditions for availing input tax credit have been fulfilled. Details of the GST paid on inward supplies are available in GSTR 2A except for item 1, raw material A for which the supplier has not filed its GSTR 1, supplier has not filed its GSTR 1 for the month of January 2020, hence corresponding input tax credit is not reflecting in the GSTR 2A. Now, like I said, that this was really something what I thought would not be coming. Reason is in practical scenario, this 36.4 has caused a lot of disruption. There has been I think a couple of writ petitions filed challenging the very legitimacy of this insertion of the rules, because there is no such specific restriction given in the act. It is there only in the rules that the credit which is not appearing in GSTR 2A should not be allowed. That was originally there in section 37, 38, 39, which has been contemplated over there. But this limited availability of credit for which the details are not appearing in GSTR 2A was not there. Nonetheless, we have to obey whatever the question is, and therefore, like I said, I have to give the answer. So, raw material A, 60,000, this amount is not reflecting in our credits, in our GSTR 2A. So, what is the eligible credit that is reflecting in our GSTR 2A? So ये 50,000 रुपए का जो क्रेडिट है उसमें से हमारा एलिजिबल पोर्शन इज 45,000. So that 45,000, then 55,000 because this pipeline credit is not going to be available. So this 55,000 plus 45,000, that is 1 lakh CGST and 1 lakh SGST, correct? 1 lakh CGST and 1 lakh SGST is what you will be eligible. It will be eligible credit for you. Now there is the outward liability is obviously substantial, but so what is the total credit? 1 lakh under CGST and 1 lakh under SGST. Due to applicability of that 36.4 for the missing item, I am going to take 110% of the eligible credit. So 1,10,000, 1,10,000 respectively will be considered as the eligible credit for this case. So what is the question that have they asked? Amount of eligible input tax credit. So eligible input tax credit, if you ask me, that is 1 lakh, 1 lakh. Amount of input tax credit that can be claimed will be on the basis of 110% of what is appearing, what is the eligible credit appearing in your 2A. So that will be 110% of whatever is appearing in 2A, that is 1 lakh, 1 lakh ka 110%, that is 1,10,000, 1,10,000 respectively, right? Okay, then net minimum GST payable in cash for the month of January 2020 after using the available input tax credit. So precisely over here now, if I really go on to calculate this thing, so what we'll do is we'll just quickly do a calculation. So IGST, CGST and SGST. Right. So here now how much is our this thing? So the outward liability will be 85 lakh rupees के ऊपर 18% and 15 lakhs के ऊपर 99%. So I'll just put it over here. $85 lakhs into 18%, and this will be, so my liability over here will be 15 lakhs into 9%, and over here it will be 15 lakhs into 9%. Right? So I have a outward liability of 15,30,000 as IGST, 1,35,000 as CGST, and 1,35,000 as SGST, whereas my total credit is 1,10,000, 1,10,000 and under CNS respectively. So I think over here there is no cross. I mean, and I also believe that there is no opening balance of input tax credit. Right? That is what has been told in the question, that there is no input tax credit balance of any input tax credit, and all the conditions for availing input tax have been fulfilled. So CNS, I think maximum what you can utilize is for CNS, and the balance liability will be paid in cash. So this was your question. This was a question for 8 marks, and of course for working notes also there will be definitely marks that are assigned over here. So all the adjustments that we have done, or we have discussed, this 36(4) as well as this non-eligibility of credit for the pipelines laid outside the factory premises, working notes are going to be compulsory, so that will help the purpose, and the examiner should be fine with that. Next question is, following are the particulars relating to one of the machines sold by SQM Limited to ACD Limited in month of February. A list price is 9,50,000 exclusive of taxes and discounts. Further, the following additional amounts have been charged. Now over here it's very clearly given, further following additional amounts have been charged. Municipal taxes chargeable on the machinery. So we know one thing, as per the provisions of valuation, provisions of section 15, any taxes other than CGST, SGST, IGST and UTGST and cess will be forming a part of your value, as much as it is collected along with the value of supply, or along with the supply of goods or services. So this 45,000 becomes a part of your value, so this has to be added to your value. 9,50,000 mein ye 4,45,000, this 45,000 amount you will be adding. Outward freight charges, contract was to deliver the machine at ACD's factory, FOR destination contract hai. So terms of contract ke hisab se the risk and rewards of the goods are going to be retained with the supplier up to the point of delivery with the customer's premises. Incidental expenses incurred in connection with the supply as per section 15 will become a part of value of supply. So this 65,000 should be added to your part of this 9,50,000. Additional information, Mrs. SQM normally gives an interest-free credit period of 30 days for payment. After that, it charges interest at the rate of 1% or part thereof on the list price. ACD Limited paid for the supply after 45 days, but SQM Limited waived the interest payable. Now, any interest or delayed charges by whatever name called, as long as they are recovered, they will be forming a part of your value of supply. But in the event they are not recovered, then of course there cannot be a predefined or calculated value for that which will be recovered, which will be considered to be added as a part of your taxable value. So that's why in this particular case there will be no added value over there. This interest and all will not be forming a part of your value of supply because it has not been actually recovered. Mensa SQM Limited received rupees 50,000 as subsidy from one of the non-government organization on sale of such machinery. The subsidy was not linked to the price of the machine and also not considered in the list price. Now there have been some conflicting opinions with regards to this non-inclusions or inclusions. As much as the subsidy is not linked to the price, usually it does not affect your value of supply. And since it is, again, more importantly, that it is received from any person other than central or state government, so usually it attracts the addition in the value. But my contention with respect to this is that since it is not linked to the price, it will not be considered as a part of value. ACD Limited deducted discount of 15,000 at the time of final payment, which was not as per agreement. Now again, with respect to section 15 subsection 2, the provision, 15 subsection 3, the provisions regarding discounts are very clear. If the discount is given before or at the time of supply, the same needs to be reduced. If the discount is given after the supply, then that discount will be reduced from the taxable value by issuing a credit note only if the discounts are predefined in the agreement or pre-agreed with the buyer. So this discount will also not be reduced. and SQM collected 9,500 as TCS under the provisions of income tax, that is okay because that is not going to impact my valuation. Okay, value of supply मेरे से impact नहीं होने वाला. List price plus additions and additions and non-inclusions, that will be the only value I need to be really worried about. TCS should not be really a matter of worry for me. So again, with working notes, this is how it will get justified, right? Now, in the following independent cases, decide which person is liable to pay GST, if any. You may assume that the recipient is located in the taxable territory. Ignore the aggregate turnover and exemption available. We transport a registered goods transport agency paying IGST 12% transported goods by road to road of Dilip and Company, a sole proprietary firm, other than the specified person which is not registered under GST or any under any other law. So now over here, since the supply of services of goods transport agency has been made to a person who is an individual, okay, who is not a firm, who is not a company, who is not a registered recipient, but he is an unregistered sole proprietary firm. So in this case, the provisions of 9 subsection 3 which 9 subsection 3 which compel the applicability of reverse charge do not really exist. So in this case, it will be the We Transport who will be charging the GST on forward charge mechanism at 12%, right? Mr. Kamal Jain, an unregistered famous author, received 20 lakhs consideration from PQR Publications for supply of services by way of temporary transfer of copyright covered under 13A relating to original literary work. Now, usually what happens is that as per the original exemption, there was an exemption. However, with respect to the amendment, what they had said is if it is received by a publisher from an unregistered author, then the publisher needs to pay the tax under the reverse charge mechanism in this case. Next, BBD Private Limited of Gujarat, exclusively manufactures and sells products Z, which is exempt from GST. White notification issued under the relevant GST legislation. The company sells Z only with Gujarat and is not registered under GST law. The turnover of the company in the previous year 2018-19 was rupees 50 lakhs. The company expects the sale to grow by 10% in the year 1920. However, with effect from 1st of January 2020, the exemptions available on Z was withdrawn, and now 1st Jan 2020, okay, so during the year 2019-20, on 1st of January onwards, the exemption was withdrawn, so his goods have become taxable, and 5% GST was involved. The turnover of the company for the 9 months ended 31st December was 42 lakhs. Now, this company is of the opinion that it does not require to get registration under GST for the current financial year of 1920. So now what is the scenario that even though the company was selling taxable goods, and assume that they are exceptionally dealing only in the taxable goods, they do not have any other kind of a registration requirement. In that case also they will be required to get registered if their supplies, the taxable supplies, rather the aggregate turnover, beg your pardon, if their aggregate turnover exceeds rupees 40 lakhs, if their aggregate turnover exceeds rupees 40 lakhs, because they are exclusively suppliers of goods, they will be liable to get registered. Now in this particular case, what is happening is that turnover has exceeded 40 lakhs already on 31st of December 2019. So as much as there is a taxability also that is coming into picture, so with effect from 1st of January 2020, their goods have anyways become taxable. So now what has happened, goods have also become taxable and aggregate turnover has also exceeded 40 lakhs. So put together, I need to understand that within 30 days from the day on which these goods become taxable, the registration is compulsory. The registration has to be sought under any case. Now why so? Because the provisions of registration entail to do so. Initially, if we have also discussed one thing, that if my goods are exclusively exempt, I need not get registered. If my goods are exclusively exempt, I need not get registered about that. That is okay. There was an exemption notification and there was a notification 5/2017 which specifically mentioned that if your goods and services are exempted, then there is no need of taking a registration. So in this case, although the fact remains that since the turnover was later on exceeding anyways 40 lakhs, the aggregate turnover has exceeded 40 lakhs, plus the goods have become taxable. So put all together, within 30 days from this date, the registration is compulsory. There is no other option or choice by which BBD Limited has to go any other option, by any other way. Is it mandatory? It is mandatory to furnish e-way bill. Furnish the details of conveyance in Part B of e-way bill. Comment on the validity of the above statement with reference to the provisions of e-way bill under the CGST rule. So mandatory to furnish the details of conveyance is of course there. The only thing is that wherever below up to 50 kilometers transit, or in case that there is a case where there is absolute non-motorized vehicle transition, then you can actually go in for not filling up the details of the conveyance. Otherwise the details are mandatory. So it is like a partially correct statement, but we need to give the explanation accordingly. In Form GSTR 1, submission of invoice-wise details of outward supply is mandatory for all kinds of invoices issued during the tax period. So, not all kind of invoices. Yes, B2B invoices, invoice-wise details are to be given. B2C, consolidated details are to be given. B2C large, that is interstate more than 2,50,000 rupees. If I made a supply to a unregistered customer, then also I am required to give that separate disclosure. But with respect to the exempt supplies, where I am issuing bill of supply, there is no need of any disclosure. Then with respect to the debit notes and credit notes issued under section 34, yes, there is a need of disclosure. So they have only asked you the question, invoice wise details of outward supplies is mandatory for all invoices. So it is not for all invoices, it is only for B2B, it is for B2C large, that is for what it is only mandatory, right? Then the next one, now this was a bit, like I said in the beginning, that there was one or two questions which are a bit tricky. So I believe question number 8A is and 8B, which is the optional question. Both of them seem to be a bit trickier. So what they've asked is that who can impose restriction on utilization of input tax credit available in the electronic credit ledger, and under what circumstances can the restriction be imposed under the CGST rules. So actually what has happened is that a lot of people have got confused with after this question, because they've thought that this is about the restrictions imposed under section 17(5) for the input tax credit or the block credits. However, this question was coming from the ITC rules 86 and 86A. It only says that the commissioner or the assistant commissioner, they have the reasonable powers to impose restrictions on the utilization of input tax credit. Now I'll tell you what are the scenarios and circumstances when it happens. So if there is any assessee whose return filing has not been consistent, he has been issued the suspension notices, or if there are any kind of a if there are any kind of a claiming of input tax credits which are believed to be fraudulent in nature, which are believed to be not correct in nature, or which are believed to be not as per the provisions of the law, and that responses for the notices which have been issued has not been received, in such circumstances the commissioner and the assistant commissioner, they have the limited powers given under the the rules 86, rule 86A, whereby they can impose the limitation on utilization of input tax credit. Although this is not like a permanent ban on the credit, it is a temporary imposition which can be given. But then yes, like I said, that this was one question which was a bit kind of a surprise move, because at the practical implication with respect to your intermediate level, this was a bit challenging one. So this was one of the questions which I thought was probably tricky enough. Explain the order of discharge. The alternative question was explain the order of discharge and other dues as per the provisions of section 49 subsection 8 of CGST Act. So over here the order of discharge is given anyways very clearly in section 49 subsection 8. So whatever taxes or revenues are due for the previous year, that will be recovered first, then the taxes and revenues which are due for the current year, then the penalties, and then if at all there are any allied late fees etc., that will be recovered. So that these were very simple answers actually, but then the questions were like bit yes out of the box type of a scenario. And the last one was pretty simple, with reference to the provisions of CGST Act 2017, discuss in brief when importation of service to be considered as supply and when it is not to be considered as supply. So if I refer to the provisions of section 7, that is the scope of supply, section 7(1) clause C. So what it says is that import of, 7(1) clause B, beg your pardon, import of service for a consideration, whether or not in the course or furtherance of business, will be considered as a supply. So import of service, as long as it is happening for a consideration, whether or not in the course or furtherance of business, will be considered as a import of services where it is considered as supply. Apart from this, if I also refer to the schedule 1, that is transactions where there is a tax payable even though it is without consideration, if from a related party outside India, if from a related party or a distinct party outside India, if I am importing any services in India without consideration in the course of business, then they will be liable for tax. So these are the only two scenarios vividly where we can say that where importation of service is considered as liable for, I mean considered as supply, and therefore it is liable for tax. So friends, as much as we have discussed this and we are about to conclude on this, what I would say is that yes, this paper has given a bit of an eye opener also, that with respect to the amendments which are taking on the practical front, even on the technical points like input tax credit also, I think the institute has tried to corner one or two questions in respect to that. And like I mentioned, that the questions with respect to this particular question 8, which is about the utilization, so it's something on the rules, that is on the administrative aspect of the rules, which is again some sort of a surprise that came away. But then yes, nonetheless there was a question which was an option to that, but of course we cannot bank on the options all the way. So here I would like to conclude my discussion on the question. I hope you've got some enlightenment on the paper, and we hope to discuss soon on the other topics under indirect taxes. So till then, from Mensa classes and myself, thank you so much. Have a good day ahead.